Another
Hold on.
edition of Monday Night Live on the YouTube channel. I'm Robbie Krager, the Flip Flop Flipper, and we're glad to have you here. Bring your questions. It's my pleasure to introduce my good friend, Jack Krupey. Jack and I met at a Uncommon Entrepreneurs event, and we sort of hit it off. We've done a couple of deals together now. Jack has a past track record of massive successes everywhere he goes, and he landed on the island here to keep more of his money, and now he is investing heavily into multifamily projects in the States. I think mostly on the East Coast, Southeast maybe, Jack. And so Jack's going to tell us about that. We're going to have a conversation. We're happy to answer your questions, and we're just going to have a good time tonight, guys. Hey, Jack, welcome, and thanks for coming and sitting down.
Thanks for having me. Thanks for having me. I'm excited to be here.
Great. So listen, tell us about who you are, how you got to the island, and what's going on with Jack Krupey.
Sure. So it's crazy. It's been over 20 years at this point. The time is really flying. I got into real estate shortly after college. My college landlord owned a number of properties, and I originally thought I was going to be in the IT industry, but graduated from Rochester Institute of Technology during the .com crisis. And, the jobs, I had a job, but it wasn't really as exciting or what I wanted to do anymore. So within a year, I bought a house, no money down. Within another couple months, I bought a few more and essentially quit my job and was full-time in real estate within a year out of college. This was 2002, 2003, the beginning of that kind of the first real estate boom. And did all the traditional wholesaling, fix and flip, had a number of rental properties. Was sending those little yellow postcards out that say "We buy ugly houses," and yeah, it was. And I tell you, that was like one of my first epiphanies: is that marketing works. I was afraid to spend $700 on postcards. We went to a printer, we cut them ourselves into fours, we stamped them, we hired like an intern to stamp them, and that $700 mailing probably made us over $100,000. So that was an early lesson that you've got to put yourself out there. You've got to find a way to find your target audience as an investor.
Return. So I think that was an easy lesson to pick up on then, huh?
Yeah, absolutely. So when 2008 hit, things kind of froze. It was really hard to get loans. We had a lot of buyers were coming in from New York and California to buy property in Rochester. And, the market just froze and I was looking for something different. So I was from outside of New York City in New Jersey. And I ended up going down to New York City and found there was a private equity fund buying the non-performing mortgages after the financial crisis. So they needed real estate people. They needed people who had done short sales as investors to protect them as the bank to make sure they weren't going to get taken advantage of by real estate investors. So for the next 10 years, I was more on the banking side and started buying our own mortgages. So we bought loans from a number of private equity funds. Then eventually we grew and we were buying from Fannie Mae, Freddie Mac. We did deals with Goldman Sachs, Nomura, and it was this crazy Wall Street ride that I completely backed into and learned a lot. It was an amazing experience, but at the same time, it kind of turned into corporate hell after a while. We were
so that was your own business, though, right? Like that was
I owned a
job anymore.
Absolutely. Yeah, absolutely. I owned a piece of the business. At the same time, we were backed by a large private equity fund. So they owned a majority of it. So they have ultimately owned us to some extent as well. But I owned a piece of it. I owned a piece of the profit and loss statement and started realizing that, New York City with the high cost of living, 50% tax rate, and really just a culture and lifestyle of, not taking much vacation and just grind. And eventually I was looking for something something better. I got into real estate because of the passive income and the lifestyle that it can afford if done right. And, what I realized, and I see a lot of other investors, those that, don't get to scale or don't set up the proper systems, that they if you're not careful, you can create yourself a job and trap yourself.
Many business people are guilty of that, especially when you are starting your first business or getting involved in real estate. I mean, a lot of people go into something called wholesaling where they're flipping contracts, and basically they've created a job for themselves, right? Like there's not a real exit on that because it's all tied to their whatever they can personally do. And that as entrepreneurs is something that I've struggled with, right? Like for years and years, we had a business that did really well as long as Robbie Krieger showed up 70, 80 hours a week. And it's probably still to a certain degree that way, but as I've gotten older, we've tried to scale it in a way where we can have a better lifestyle. And we now think about things like balance and stuff like that. Stuff that as, you know, a 26-year-old guy starting out, I didn't think about balance or lifestyle or any of that. I was just trying to feed a family. So the time we met when was at the Uncommon Entrepreneurs, you had just arrived on the island and you were about to have this liquidity event. And I think you were having that epiphany at that point that, hey, living in New York City is a lot more hectic than living in San Juan, Puerto Rico. You want to talk a little bit about
absolutely.
that decision?
Yeah, absolutely. So, in 2019, I moved down here at the end of 2018, and I stopped being an employee of the business, but I still owned a piece of it. And what I realized is the tax code is really not meant for employees. Even though I owned a piece of it at the time, I was still a W-2 employee. I was a worker in the company and owned a piece of the company. And the tax code is really not set up to be optimal for those that work a W-2 job and those that have active income. Yeah. What ended up happening for me is I was making more money from my ownership of the business than the money I made from my W-2 salary, just because the business was highly successful. And when I quit my job, I actually pretty much made the same or more money, because at that moment, my income became passive instead of active. The moment you have passive income, the tax code opens up tremendously, and you can use things like accelerated depreciation and offset a fair amount of your actual income. So being a real estate professional or just having passive income is way, way more advantageous. So when I moved to Puerto Rico, even without the Puerto Rico tax incentives, which were a whole different level, my income basically increased. Leaving a six-figure salary didn't really make a difference. So eventually, after a year and a half living down here, worked out a deal with my other partners, ended up getting bought out, and it was tax efficient for being down here. And I had a pile of money I needed to figure out what to do with. And learning from some of my past lessons, I didn't want to start over and create another job. Yeah. So fortunately, I'd been investing passively in these larger apartment complexes during my time in New York. And when you invest in a 200-unit apartment building, as an example, that's big enough that there's on-site management, a team of people in place typically. So it's more like buying a business than just buying a piece of real estate. The real estate is attached to it, but when you're at 200 units, it's at a whole different level. You're at a level where
that has employees and staff and management. To your point, you need to evaluate it going in, but once you've purchased it, hopefully your staff is running it and increasing the cash flow the way that you want it. And I know actually, having talked to you, you've had some pretty exciting liquidations inside of your fund, even maybe some stuff that you didn't anticipate selling as quickly as you did, and you guys made phenomenal returns. And I don't know how much you want to brag, but I'll brag for you, because I know you've done really, really well, and it's been fun to watch.
Yeah, no, I appreciate it. Yeah, we did have one deal. One of our best deals was a deal we were in it for 12 months and 2 days, and achieved a 97% IRR. So we almost doubled our money in 12 months. Yeah. And look, I mean, we had a good partner on that deal, and it was in the Phoenix market, and it was a heavy value add. So we were renovating a number of the apartments, and the power of real estate, the power of leverage as well. If you are raising the net operating income, where most commercial buildings trade on net operating income, if you could raise rents by renovating an apartment by $400 a month, that's almost $5,000 a year. So at a 5% cap rate, you raise the income by $5,000. You can multiply that by 20. And you're raising the value of the building, depending on whether it's a 5% or 4% or 6% cap rate. You could generally, for every $5,000 in profit increase, you're raising the value by over $100,000. So that's extremely powerful. And that works on less than 200 units as well, but it's really any cash flowing real estate. Just by increasing net operating income, you can dramatically increase the valuation.
Well, and you have some bigger institutional buyers that will line up to buy your 5 cap 200 unit apartment buildings, where they're not going to buy a 5 cap house in Central Florida from Robbie Krieger although there are some funds that do buy that kind of stuff. But I think that your product lends more to the kind of valuations that you're talking about. So.
Yeah, absolutely. The other big difference about these larger 200 units is that cost segregation I mentioned earlier. And, if you have a single family house, you're likely depreciating it over 27 and a half years.
Right.
In some of the more expensive areas, the land value is sometimes worth as much as the house in some of the expensive markets. So when you do a cost segregation, the land value is taken away. So it's often just not worth doing. However, on these larger commercial 100, 200 unit buildings, self-storage, mobile home parks, all of these syndicated asset classes, you could generally get about 30% of the value, the improved value, as depreciation year one, because the engineering firm goes in and says, well, you have 10 buildings with roofs, those have a 20-year life. You've got 100 kitchens, 100 bathrooms, 200 whatever it is, and they'll look at everything and say, well, your average life is 12 years, and anything with less than 15 years can be taken as bonus depreciation. And up until the end of last year, you could take 100% of that year one. So what it worked out to on simple math is putting $100,000 into a syndicated apartment complex in many cases was yielding between 80 and 100,000 in tax loss year one, and that's just a paper loss. You are getting depreciation on an asset that's actually appreciating in value, but you get to take the tax loss right away and defer your taxes.
So if I'm a doctor or a dentist and I have some nice income, right, and I'm still working for a living, I invest into your fund, and you're passing through this depreciated loss for me to offset normal income. Is that? Well,
it can be pretty complicated, and I'll give the disclaimer that I'm not giving official tax advice, although we will work with our investors and their CPAs. Passive losses cannot offset, say, the W-2 income, so the primary doctor's income. But if they own other properties, it can actually offset the rent from other passive properties they have. And I actually did a podcast with the CPA recently, and one of the most interesting loopholes is the spouse. If you're a brain surgeon making $2 million a year, but your spouse qualifies as a real estate professional, and that could be a combination of being a real estate agent or directly managing, a few properties, it works out to, if you spend 500 hours, 750 hours is a real estate professional, whether it's an agent or something in the industry, and 500 of those hours specifically on rental property activities, that qualifies as a real estate professional. The moment that happens, all the income is combined. So I've been to a mastermind group that has a lot of dentists, and a lot of the dentists, their spouses are real estate professionals, and between the two of them, they're able to actually pool all their income together, and all their real estate investments can offset their active job. You make $2 million as a brain surgeon, you can book $2 million of depreciation as a real estate professional, and really dramatically lower taxes completely in a legal way. Legal way.
And Jack?
Yeah, it's great. I mean, there's a reason, the rich people essentially write the tax code, and it's really meant for business owners, entrepreneurs, and those with passive investments. So, and that's not a political statement. That goes across party lines. Accelerated depreciation has been around in the tax code for 30, 40 years. They made some adjustments in 1986. I think that was the last major time they made a negative change to it. But even then, they just closed that passive loss loophole in 1986, where before that you could literally just take all your money, put it into deals, and completely offset taxes. So they made it a little more difficult back then.
Yeah. So now you're raising money actually right now for your fund, right? You have an
Yeah. So, JKAMinvestments.com. We have two funds currently. We have one fund that's completely diversified. So what I found is if someone wants to get into a syndicated real estate deal, maybe they're in the stock market, maybe they've bought a REIT here and there, but I think over 90% of the population of accredited investors hasn't done anything other than have money in the stock market or maybe buy their own house. And I found a lot of people want to figure out how do they get into the space, and it can be daunting because there's a fair amount of funds out there. There's a lot of people saying, hey, invest in my property here, invest in my 80 unit in Texas, my 200 unit in Florida. And how do you pick which partner to work with and which market? And most investors only have, maybe an initial budget of a few $100,000 to go into something different and new. So we wanted to provide that diversification. So what I've done is I took the top 15 partners that I've worked with over the years, and I have a fund that invests into all of their deals over a 12 to 18 month basis. So if you invest in my fund, you own a piece of assets in Houston, Texas, Jacksonville, Florida, Fort Lauderdale. We actually have another fund that we invested in, that we co-invested, that has about 30 assets in it. So it provides a broad diversification across various markets with various operators. And we negotiate better terms often than what someone would get if they put a few dollars in directly, because we're writing larger checks and we write them consistently. Yeah. So that the diversified fund is a great option. And we recently launched a new platform where investors can actually invest in individual deals all through one website, where once you log in and you join the fund and you're an accredited investor, you could say, if you want to really only be in one deal or you want to pick and choose, we now have the ability through a separate fund for people to pick and choose individual syndicated properties that we have vetted with our trusted partners. So we have two options. You could be fully diversified or go directly now.
And so how many properties are you looking at typically in any year? Are you going to buy a few more this year? And are you trying to always add to the kind of book of business?
Yeah, I mean, we probably only do at most 1 or 2 deals a month. And with that said, to take a step back, the reason that we're not the day-to-day operator that's swinging the hammer on these properties, because we're buying businesses in many cases, these 200-unit buildings. Yeah. However, our operating partners, the people that are the boots on the ground in these markets, they often look at 200 to 300 deals for every one deal they buy. And so each of these sponsors is looking through 200 deals and finds one. And then we may have 5 or 6 deals between all the sponsors at any given time, and we pick 1 or 2 at most to invest in at any given time. And that really just depends on just where we see the market. I mean, there's a lot of noise about interest rates over the last year, whether we're looking for more growth or more cash flow, and we want to balance a portfolio. So, as an example, we got sent a number of deals this week, but my favorite one is in Fayetteville, North Carolina. And that's because it has fixed interest rate going in. And it has a much higher entry cap rate than I've seen recently. It's 7.5%. Okay. And the immediate cash on cash return is over 10%. One of the downsides of many of these value add apartments is a lot of times the first year you don't get a lot of cash flow, because you raise the money, you're renovating the units. It takes some time to renovate, and then once you're done renovating, then the cash flow is much higher. But this deal has built-in cash flow from day one. And that's important to a lot of our investors. With a lot of the noise in the economy, want more current cash flow, and that's something we're trying to solve for. And we're refocusing a little bit more on deals that spit off current cash flow. So,
tell us, if I'm just a Joe investor and I catch our YouTube and I like what I'm hearing, and I can't imagine that my dentist or my doctor wouldn't like what they're hearing. How does it work? So walk me through. I've got a $200,000 that I want to invest with you. What are you offering through your fund? And is there a preferred return? Is there some guaranteed pass through of these depreciated assets, or how do you make it fun for everybody?
Sure. So essentially, it's an LLC. So when investors interested. Number one, they go to our website, they go through and click to create an account, and we have a specific portal that has all of the legal documents. So we'll have a conversation and make sure an investor understands, and B, we'll make sure that they do go through and read all the fine print and disclosures. I'm going to give a high level, but ultimately, anyone who's going in needs to read all of the legal docs and the private placement, which has a million different risk factors of what happens, including pandemic, which has been added to recent private placements as risk factors. But it's ultimately pretty simple. It's ultimately you're buying into a partnership. So it's an LLC, and we structure it as we pay a preferred return on your capital while we have it. And generally we have the capital for 3 to 5 years. And so while we have the money, it's almost like we're paying a loan payment. That's a preferred return. And we pay an 8% preferred return for most investors. We have a 6% class, but anyone who's writing $200,000 check is getting 8% annually, and we do pay quarterly. If there's not enough rent coming in that quarter to pay the entire return, it may accrue. So again, it's not like a loan payment specifically. It's not timed like a quarterly, but it is paid. The guarantee is it's paid before we get paid. Yeah. and it's generally the deals we're targeting that pay about 6 to 8% from the rents. So what you get is the rents that come in are generally paying that preferred return. And then when there's a liquidity event or a refinance, we actually return principal. So in a fund that has 10 to 20 assets, what we say is, you put in 200,000 for the first 2 or 3 years, you're going to get your 8% on your 200,000. Year 3, we're going to return $100,000 or something similar from a few of the properties selling, and now you get your preferred return on 100,000. Year 5, we've sold most of the assets, but we still have a few extra left. We'll have returned all of your money. So now you have no more preferred return, but you still earn your percentage on the rest of the properties until everything sells. And the way we do is at 70% to investors. Mm-hmm. The only time we get paid anything significant is the 30%. Once all money and all preferred return is back, we take 30% of the profits at that point.
Wow. I mean, that's a sort of standard deal structure. I think pretty aggressive for your investors. It ought to keep people pretty happy.
Yeah, I think so. And I get some questions because a lot of people have the New York City hedge fund, the 2 and 20 type of thing in their minds. So like, well, why are you taking 30 instead of 20? The difference between a syndication and real estate and a New York hedge fund is we have a preferred return. Yeah. A hedge fund is more of an open-ended thing where maybe they make a 30% return 1 year and they take 20% of it, but the next year they could lose 20%. Yeah. And so for us, there's a hard pref.
Measure the risk, and you're also doing more of a vetting. I mean, you're partnering with other managers, but you're also vetting the managers, so they get a double insulation on your expertise and somebody else's expertise who also has a proven track record. I love this structure, and quite honestly, I always like when someone's willing to work for me until the end, and then I want you to make a ton of money, right? So you're basically paying out for the first 5 years all of the money but enough to live on, and then you have a responsibility to yourself, which is really good, and to us as an investor, to have it go as good as possible, and that's where you will get paid. That's where you get to really benefit from doing all of this work for several years. So that's awesome. That's just awesome. Yeah.
Yeah, absolutely. I appreciate it. And it's a perfect fit for me as a business because I really like strategizing with my investors and figuring out their situation. And I have a close friend who's an investor who is going through that scenario where his wife is becoming a real estate professional. And, she used to have more of a corporate job and wasn't happy. And they realized that, financially it would be a savings for the two of them if she didn't go get another job and just became a real estate professional. And we're working.
So what does that mean? You encourage them maybe to buy a rental house and have her spend a few hundred hours on it?
Yeah, absolutely. I just walked them through that whole process. And it's partially investing through funds like mine and partially doing a little bit of hands-on so that the hours are combined. But 500 hours or 750 hours is like 15 hours a week. And whether you're counting whether you're counting 52 weeks a year or 48, depending on your vacation time. So, it's not a daunting amount of time if you set up your life in the right way. So I just enjoy sharing that knowledge. We have an informal mastermind group of investors that, everyone's trying to accomplish the same goals of growing their assets. And, one of the common themes is wealth without Wall Street, where, we're trying to find alternatives to that standard stocks and bonds. And, most financial advisors have no incentive to refer any deals that have better returns through these markets because they can't get paid on them. Yeah. So nobody at a top 10 shop is going to recommend, putting money into a syndication deal, into a private lending deal, into a deal opportunity zone deal in Puerto Rico or one of my funds. So we have to do our job to educate because the financial advisors are mostly not sending them our way.
Man, that opens up a can of worms or another kind of conversation. We could go this direction, but I have a thought on these fund managers that you're talking about, this Wall Street idea. I believe that they're telling people the wrong thing, right? Like I think that if you look at how people become really well off and wealthy, even, you almost always do it either through real estate or eventually if you make a whole bunch of money in some other business, you protect it by being in real estate. And yet 90% of what you would hear from professionals who manage money is going to tell you to be well diversified across the stock market. And I think it's just kind of garbage. So I'm so glad to hear you say that you educate people about this, because I'll tell you what I think, and then you can tell me if you think I'm crazy or not. But I think a well-diversified portfolio needs to have at least like 70% of the portfolio in some form of real estate investments, whether that's mortgages or actual owning of rental properties or being in syndications and things like that. I think that's how you can really expect to have a great lifestyle at the end of your work career, as opposed to just saving your money and putting it into a 401k and investing in the stock market and doing what we're told to do. I tend to never do what I'm told to do, and so that's my thought. That's what I'm telling people. I'm like, if you want to do it,
no, I certainly agree.
Real estate.
Yeah, I certainly agree. Whether it's some people maybe 70, at least 50, I think, or somewhere thereabouts. And up until recent years, what are you getting?
I was 100% up until. Well, I'm probably still. But that's just me. I feel safety in owning real estate. It's an asset class that just doesn't devalue very often. It almost never goes to zero. And unlike the stock market, if we have a correction in the stock market and you have $1 million in there and your stocks correct, they can correct to a zero and never come back. Real estate can correct, and we just saw this in 2008, but it came back 100% plus if you just held on to what you had. I mean, if you had invested in a house in Central Florida and it was 300 and it went to 100, it went back to 400. Stocks don't do that. But that's not, we don't get to hear that from the professionals that are out there. So.
Yeah, and it made me think of something, because one of the objections I get from time to time, some people are really concerned with locking their money up for a 5 to 7 year period. However, what too many investors do is the moment the stock market drops, they panic. They panic and they sell at the bottom.
They pull out at the wrong time.
Exactly. So, with our funds, I mean, there's been, the fact that there's not a lot of liquidity, we don't have to sell anything for the next couple of years. We don't have any debt that matures in the next 2 or 3 years. So while there's a little bit of noise with interest rates, and like this next couple months is not the ideal time to try to sell a property, but we don't have to sell anything. Whereas if you owned a real estate investment trust, number one, even though it's supposed to be tax efficient, it's actually the worst tax efficiency for high net worth people, because they end up paying 29.6% on dividends. Whereas the private deals, you're actually getting deferred cash flow with to completely tax deferred cash flow, because you show a loss on paper while you're getting that annual return, that whether it's 8% or 6%. So it's a lot of people panic and sell REITs. REITs had a bad year last year, even though our properties and largely the syndicated real estate deals are just plugging along. Yeah.
And so that leads me into my next question. And which markets are you kind of highly anticipating finding some bargains in, and where will you focus your acquisitions maybe throughout the next year or 18 months?
Yeah, so it's still a lot of the same. I mean, you mentioned the Southeast. Yeah, we're primarily in the Southeastern U.S. We're also in a number of Sunbelt markets. We're in Dallas, Houston, Phoenix, and Vegas. And I think that as long as you're in an area with high population growth, we're focusing on areas that still have population growth. And we're not at the high end of the market. You see a lot of headlines right now about, prices dropping, rents dropping, and in select markets it's happening. But if you look at the deeper details, there was just a report that Phoenix rents were down 5%. However, when you look at the fine print, rents were down 12%, give or take, on the high end market. And rents were actually still up 3% on the workforce housing market, that, middle class, working class, workforce housing, that, you call it whatever you call it. And that's the market we like to be in, where rents are somewhere between, $800 and $2,000 a month. We're not typically going for the high end of the market. So we'll continue to look at those markets. And what we're seeing is there have been some price adjustments. There's actually less inventory and less sellers right now, because it's not the opportune time to sell into a slightly higher interest rate environment. But for those that do have to sell, there are some opportunities, and prices have come down, a few percent or more. And we still look for deals that work in any market. That value add scenario where you have a 1980s vintage apartment where, the owner, it's fully occupied, a nice enough building, but still has Formica countertops. They have basic carpet down.
Yeah.
The kitchens and baths are from the 80s. You take that unit in a market where there's a shortage of housing, and you cannot build workforce housing. If you're building new construction, you're building higher end in general, unless you've got massive government grants or subsidies. Yeah. So we take those buildings that are nice but underappreciated and dated, and renovate, and all of a sudden it's the nicest Class B unit you can find. There's a waiting list of people that'll spend $1,500 a month for an apartment that used to be $1,100 a month because it's very nice. Then we put in things like dog parks, things like barbecue grills, repave the building, change the signage. And if you do that, it doesn't matter what market, it doesn't matter if rates go up another point or 2 points. At the end of the day, you're creating so much value that it's going to far surpass any economic headwinds there may be over the next year or two. And even if there's a recession, people are going to downgrade from their Class C, high-end Class A apartments to the nicest kind of Class B simple apartment they can find.
I love your investment strategy. I love value add. That's what we like to do, value add, highest and best use type combination stuff. You answered a question for me. You didn't even realize I had the question, but I have rental properties in the States as well, in Orlando, Florida, and I'm hearing about these rental markets coming down, but I haven't experienced it at all. And literally for the last month and a half, I've been seeing this doom and gloom stuff about rents coming down. Rents are coming down. And I'm going, that's not what's happening with me. I mean, we're taking a house where a guy moved out. He was at $1,500 a month. And we're going to raise rents to $2,000 a month after some renovation. Just like you said, we're going to make it the nicest house in the neighborhood, but rents are through the roof for us. And I was actually scratching my head a little bit for the last month and a half, just wondering, is it going to catch up to me all of a sudden? And I'm going to be completely wrong about this. So it's an interesting thing to see. And that is sort of what we've seen in Puerto Rico, is that Puerto Rico has held strong in the working class neighborhoods. But if you bought the $45 million home over in Dorado, you're probably not feeling real good about your decision, right? Like, if you bought that, you don't have to sell. You've got no pressure. Everything's fine. But that product has kind of just fallen off a cliff. So
yeah, hey Robbie, let's get out our violins for a second for the poor guy who's losing $1 million on his $45 million.
Honestly, Jack, all he has to do is just wait. 5-10 years is going to cure all of his problems, and he'll sell the house for $70 million. No problem.
Probably, yeah.
If he needs to sell it this week, he's in trouble. So, but that's awesome. You have that knowledge, and it really makes sense. So can we talk about it a little bit more? Because, I think that if I had the question, if I've been hearing as a guy who owns rental properties that rents are down, and I literally have been scratching my head as to why are they saying rents are down when all I'm seeing is that I can raise rents 25%. So anyway, I don't know. I'm just excited about what.
Yeah, no, it's great to hear a real story there. I mean, to dive a little deeper, just think about what's happening in the residential market. And as someone who lived through the 2008 crash and worked on Wall Street buying loans, it's completely different this time around. I talked to a lot of people who just like, I'm just waiting. I'm just gonna catch the bottom when we have another crash like '08. And big difference this time. In 2007, 6, a lot of people shouldn't have got mortgages, and they got bad loans that were these option arms that were essentially going up, guaranteed to go up in rate over the course of the next few years.
Yeah.
Now the loans are underwritten to a much higher standard because of some of the various laws and the ability to repay. And on top of that, we had record low interest rates for a decade, and really the last 2 years were really record lows. And what you have is 40% of the population actually doesn't have a mortgage. That's something that's forgotten about a lot. There's a lot of baby boomers. A lot of people have houses paid off that just don't have debt on it. Their goal in life was to pay off a loan. 30% of people locked in below 4% over the last couple of years. Those people are not going to be forced to sell unless they have a major life event. People are just waiting. Because why, even if you have a house that you bought for $500,000, and I don't know, Orlando, there's probably a lot of $300,000, $400,000, $500,000 houses that, would be the type of house that maybe in the past your tenant would go buy a house for $2,000. Now there's not enough inventory because no one's going to sell their house for their 3% loan to go pay 6 or 7% to buy a slightly bigger house. So there's not a lot of inventory, and your tenant who is, paying you $2,000 in rent, it's going to cost him $3,500 to buy a similar house, or $3,000, or there's definitely a difference where even with your rent at $2,000, it's cheaper than buying. without a down payment. And it's probably going to be like that for a number of years. We may be turning into more of a renter nation.
It does seem that way. And there's been, I mean, there's a lot of evidence that would say that these big funds that have bought up a lot of single family homes, those homes just aren't going to come back on the market. So that's also going to keep us from having this huge correction that a lot of people are calling for. And look, I don't have a crystal ball, but I know what it felt like in 2007. And I knew that I needed to get out of the market and get to cash. This time it feels very different. That doesn't mean that we're not going to have a correction, but I don't think it's going to be the catastrophe that it was. I mean, there are some really smart people saying that it is, and I think we'll hopefully be prepared for that. If the market does crash, then we're going to buy a whole bunch of real estate.
Yeah.
If the market doesn't crash, we're still going to buy some real estate. So, and what we know, because it happened just 10 years ago, we know how this movie ends. So if there is this massive correction, I've told my friends, you can't hold me down. Like I'm going all in on the parts of the market that I'm very familiar with, which is working class housing, right? So I mean, and I think would go all in on multifamily stuff, which the value add multifamily stuff, and so I wouldn't say that I'm rooting for this big correction, because I'm not at all rooting for that. But if it does happen, I think we can be prepared for it, and I think through your fund and things like that, you can set people up to be prepared to profit through this.
Absolutely. And one of the best things we do, and you do just by being continually in the market, is dollar cost averaging. And it sounds like you took a little break in 2007, because that was such a, I guess in hindsight, it was so crazy that, I think everybody should have known, but those of us that were in day to day, saw it firsthand. But, dollar cost averaging is a powerful thing. There's a case study about, and you could do this for 1929, or you could do this from, 2007, 2008, large stock market crashes and real estate as well. And it works out somewhat similarly. If you put all your money and bought everything the day before a crash or the month before a crash, all your money in at one shot, in the 1929 example, it would take you 12 years to break even. However, if 6 months before and 6 months after the big crash, you put your money in equal installments, you would be positive in 2.5 years.
Wow.
And you could use that same example for most real estate markets, even the Phoenixes and the Floridas, I think, where you bought somewhere before the peak, but then you kept buying as things dropped. And, a lot of those markets started recovering pretty quickly by 2010, 2011. It's however you slice it, there's amazing power in dollar cost averaging, and it's very, very difficult to time the bottom or the top of any market.
It is. And so I have recently been saying on my YouTube channel, don't wait for this market to crash. Always be looking for and buying really good deals, right? Like there is something that's a spectacular deal, in your neighborhood potentially, especially if you live in Puerto Rico. Like there is a gluttonous amount of great deals here. So we want to be buying those all the time. Anytime we can go to bed with a smile on our face because we've got such a great deal. And time cures real estate problems. Like owning stuff for a long period of time, and I don't have the math the way that you do, but I do know that through experience, owning something for 5 or 10 years, you're always going, like that $44 million house in Dorado. If he tried to sell it today and he could only get 30, and he waits 10 years, he's probably going to get 60. So time just cures the problems for real estate, and we don't have the go to zero and never come back kind of problem that the stock market has. So, yeah.
Absolutely. I want to point one quick thing out, because I talk a lot about, passive and make it seem, I don't want to make it seem like there's not work involved. In my case though, and for those that I advocate are better being a passive investor, if you're a high income earner, you've got a great business, you've got a high W-2, buying a single family house to do on the side might be not the best use of your time.
Right.
But what maybe is coming down to, I know there's an upcoming mastermind that you're going to be participating in Puerto Rico. I'm going on a real estate investor cruise in February. I spend over 100 nights in hotels going to conferences, speaking at industry events where there's other operating partners that we work with to find and vet and look at properties. So being passive doesn't mean that you're not actually spending a fair amount of time vetting the right partners to work with. It just means that once you're in the deal, you're in a deal that's of a more institutional quality, where you're not the one getting a call at 2 a.m. that the toilet's overflowing.
Yeah.
So there's there's still work involved is the point I want to make. Because sometimes sometimes I feel like I gloss over it. It just seems like too good to be true that you can earn mailbox money without doing any work.
Well, and people investing in your fund can get closer to passive than, for instance, you or I. Like, we do try to make our investor partners receive pretty close to passive income. Like, if someone invests with me in a 12-unit apartment complex here in Puerto Rico, and they're in Florida and they send me some money, there's very, very little that they need to do other than get on the phone and say, hey, Robbie, how's it going? And then we send them checks, right? But I still work 12 hours a day, 6 days a week. I mean, there's nothing passive about what I do. You spend 100 nights a year in a hotel and speak at events and you're raising money. There's not a lot of passiveness about that. It can be fun. It can be a nice lifestyle, but you're working your ass off so that they can have mailbox money and so that they can.
Oh, absolutely. Absolutely. And some of the, those of them that are lucky that just like knew us already or met us through, just in passing, maybe they got lucky. But I think, of the people watching, maybe some of them have been, going through 50 other YouTube videos on Bigger Pockets, other places, and somehow they stumbled across it. Just stumbling across it is doing, likely they're doing some of the work because they're researching to find better alternatives to that traditional financial system that I mentioned. So that part's where the work and the diligence comes in. And, I hope anyone listening, takes a look at our site and has a deeper conversation with me, and that we can, maybe provide them a better alternative for their investments, just like you and I both do for many investors. But yeah, it's definitely, the research is there. It's not on this little cookie cutter silver platter like you'd get from one of the investment banks or one of the stock brokerage exchanges. But ultimately it's a better return, and it's because it's not as readily accessible. And that's why the returns aren't as good in most cases, because they don't have to be. If you have people that accept a 4% dividend, and you have a system of financial advisors that are pushing that, treasuries are 4.6%. That's a good return. And I've heard people brag about that lately. Like they don't realize inflation is still really 8, 10, or if you use shadow stats on the way they used to calculate 15% right now, that you're losing money.
Well,
they're losing money if you're only making 4% a year.
They're looking that they were getting 2% and now they're getting 4.6% and they're doing great. The problem is that when they were getting 2%, there was no inflation, and now they're getting 4.6%. And I mean, maybe you can talk to this because you're a pretty smart guy, but I don't believe for 1 second that inflation is under 7%. I think it's more than double that, but I don't have, again, the stats to back it up. But what are your thoughts?
Yeah, and look, I know just enough to be dangerous on it, but I mentioned there's a website called Shadow Stats, and they used to calculate inflation differently, because they don't want to print what looks like a bad number. They just kind of change the formulas. So if you go to Shadow Stats, you can see what inflation would be if they used the old way of calculating, which they had for many years. So I don't recall what it is of today, but I'm pretty sure it supports exactly what you said, that it's more like, could be more like 15%.
Well, and I just go by, a dozen eggs are over $5. I don't drink milk, but a gallon of milk is through the roof. Gas has come down a little bit, but it's still grossly expensive compared to what it was just a little while ago. And interest rates are really a telltale, right? Like, we know they continue to raise interest rates because of inflation. So if inflation's really only 6%, then they can stop that raise of the interest rates sooner than they're going to. But yeah. Who
knows there? I mean, the one interesting thing that I've listening to a lot of Peter Zeihan recently. There's a lot of people in our circle who have read his book, and what they're trying to do. The other thing is labor. And, you hear a couple layoffs here or there at Apple, but there's still a pretty pronounced labor shortage. And some of that is just demographics. You've got the average baby boomers turning 65 this year. There's a lot of people that just left the workforce during COVID and didn't come back. Yeah. So it's going to be harder to tamper down on inflation, because there's still a shortage of workers in many markets. And if Apple and all these places lay off, that may do one thing, but it's not going to replace the shortage of construction workers, the shortage of warehouse workers. That's where you hear there's still a lot of pain. And I don't think unemployment's really going to move significantly higher with another half a point interest rate hike.
Yeah.
That all that's going to do is create more pain for the middle class. That
If
actually looks at the price of eggs.
if it does move the way they want it to move, that's super painful, right? Because I'm talking about the government, the market movers, they're looking for unemployment to become a problem. And like you said, there's a labor shortage, so it's going to be a difficult ask or a difficult get, right? So if you're moving your chess pieces around the board and trying to manipulate markets, when you have a labor shortage, how do you also then go cause higher unemployment, right? And that's kind of what they're trying to do.
Yeah, and that's where I just don't get it. And look, it's obviously, I freely admit it's way more complex. Than there's the butterfly effect. If you make one decision and there's 5 other unintended consequences, but it doesn't make a lot of sense to me currently. And ultimately, just try to make the best decisions we can with the information in front of us. And I do feel pretty good about both of our theses. I think we're both pretty well hedged in a scenario in sort of the kind of the worst case scenario. We should still be all right.
Imran is asking, Jack, if you can run through the waterfall or the preferred.
Sure. So I'll give our fund as an example. And in some cases, the waterfalls can get more complex. Some deals have multi-levels of waterfall. But simplest terms, when you put money into the fund, you get paid a preferred return on your money while we're using it. So for the first few years, we're paying, say, an 8% preferred return. The moment that one of the properties sells or refinances, it's called a capital event. And in simple terms, let's say we buy 10 properties. After 3 years, we sell 5 of them. And those proceeds are enough to return 75% of your money because we made a profit on them. So now we've returned 75% of your principal. We're still holding 25% of it. So on 100,000 investment, there's still 25,000 left. We would still pay an 8% pref on that 25,000. But your 75 is already returned to you. Now, another year goes by, we sell 1 more building. And now we're able to return that. We pay your 8% for the year, but then we return that 25,000. You now have no money left in the deal. So there's no more preferred return because you already have your 100,000 back in your pocket. We still own properties though. Those remaining properties, as any rent comes in or any of the remaining properties sell, all cash flow that's distributed is 70% to investors. And at that point, we take 30% of the profits. And that is the remaining waterfall until everything is, until the final property is liquidated.
And do you have people that are pretty happy with what you're doing and they want to reinvest along the way? So you send them 100,000 and they say, "Oh, Jack, hold on, let me give it back to you."
Yeah, absolutely. And most investors actually don't want their money back. They know it can come back, but they really don't want it back because, at least up until last year, it's going to be sitting in an account making nothing or 2%.
Well, especially if they're living on that 8%, right? And that's a pretty common way that you would retire, is to give someone like yourself a chunk of money and live on the 8% and let you continue to grow the money along the way.
Yeah, absolutely. We've actually had a number of investors ask about sort of like a dividend reinvestment plan, and just the structure of the fund and the platform. It's not because it's not an open-ended fund. It's a little difficult to set up that dividend reinvestment plan. But yeah, most people actually just want to keep the money working for them.
Yeah, that's right. I would think that if you continue to have liquidity events where you're making close to 100% in a 12-month period of time, there's going to be a lot of people ready to send you back the checks.
Yeah. And look, full disclosure, that was, an amazing deal. They're not all going to be that crazy, but what we are trying to do is pay that 6 to 8% each year off of the rents and earn close to a 15% target overall. 15% annualized. We use the term IRR, which is, a common term in the multifamily and it's more of a Wall Street term, but it loosely correlates to an average annual return. But the only way to really calculate it is to stick it into Excel. Have
built-in liquidity timelines? Like, so you go into an investment in Jacksonville, Florida, and you're doing a value add and increasing rents, or are you planning to hold it for as long as it's profitable, or is there 5 years from now, we're going to liquidate that asset and then we're going to buy another. How does that work?
Sure. Well, most of the deals range from 3 to 7 years. There are deals where we go in expecting it to be roughly 3 years, but it's not out of the question that it could be 5 or 7, depending on what's going on with the asset. The most recent one we're looking at, it shows, we're targeting, it's a 6-year hold, but they're targeting in year 3 to do a cash out refinance and pull out a good chunk of the money, because they're going in with insurance company debt, so it's a lower loan to value. And the plan is after 2 to 3 years, as the business plan comes together, we'll be able to refinance and pull a significant amount of cash out. And most investors, when you have most of your money out, you don't mind it going longer. You don't mind if it goes 10 years if you're still going to check every month and you already have your money back. Other deals, we go in and we say, okay, this is probably a 5 or 7 year deal right off the bat. And a lot of times it's the debt terms that dictate that. There are deals where you have 7-year fixed rate debt, and there might be a prepayment penalty for the first 5. So you just plan, this is a 5-year deal.
Got it. Imran's asking another question. Is there a different allocation for diversified versus syndicated funds, or I'm not?
Sure. So our diversified fund is kind of I'll use the term fund of funds because that's a term that's sometimes used in Wall Street, but it's really a fund of individual syndication deals. Most of the investments that our fund invests in are individual property syndications. So the fund is diversified across various syndicates, and in a few cases, the fund is invested in other funds. We had an interesting opportunity to invest with a $300 million fund where we got in at the very end of their fund. They already owned 30 plus great properties with fixed rate debt, and we were really the last investors in. And this was over the last summer when interest rates were going crazy. So I just really liked that return profile, and we got a better deal because of it. So our diversified fund Fund 1 had 30 different individual investments into primarily other syndications. And we often get better terms as well because we're consistent and we're in the business. These are partners, long-term partners of ours. They'll typically give us a better share class than, say, if you put 50,000 directly into a deal. Our other fund that I mentioned is it actually economically looks exactly like a syndication, but we've through our new software partner, we've centralized it into one web portal where once you've subscribed to our fund, there's a number of investment options all in one place. And that includes, for example, a syndicated apartment building deal, but we also actually put in a lending fund up there where you could invest in a hard money fund that just pays monthly interest rates. And we're going to have a number of opportunities on that fund platform to invest in it.
Can we bring them to Puerto Rico? And
you could use their software platform for Puerto Rico as well. Yeah, it's a group called Avestor, and it's a great concept. It's actually very similar to because I've invested in a few of your deals. It's actually very similar to your Series LLC because it segments all the economics, but it's still technically one vehicle. So, but it's a nice web portal where you can see the different deals. And
I'm always thinking about how to bring liquidity to the island. And unfortunately, what's going on in the States, we've sort of backed up a little bit. It looked like for a minute we were going to start to get some different products through the mainstream sort of mortgage brokers, but that sort of anything that's not completely traditional has stopped at this point again on the island. So again, and you and I are looking to try to do more of that stuff. So we will, I'm sure, do more. So
yeah, absolutely.
Do you see any opportunity investing in multifamily properties in Puerto Rico, or are you mainly focused on the mainland? And if you're not in Puerto Rico yet, what do we got to do to bring your fund here to Puerto Rico? Because I can answer the question. The first part of it is that yes, there should be opportunity investing in multifamily in Puerto Rico. So maybe I need to.
Yeah, there should be. I think with that said, it seems like the culture was more built towards condos. Yeah. I don't know that there's a high amount of large 100, 200 unit apartment complexes that are not government run here. Is that, am I correct with that? It's a lot more of a condo market than a
I think
large
that's
rental.
And we're seeing, a 10 or a 15 unit apartment building we can find pretty easily, but I haven't seen very many even 30 or 40 unit apartment buildings like you do in the States, right? And certainly anything where you see a couple of 100, 200 or 300 units, those are generally looking like government housing or condominiums. Yeah. So I agree.
Great. And then to the second part
that we can work out where we invest in, a group of 10 units and just buy 10 units and have 100 units together inside of a fund that way.
Gotcha. And then the second part of the question, I had an existing investment strategy and I'd been investing in these deals for a number of years already. So, so I had kind of a turnkey business that was already operating, and I've just because I moved to Puerto Rico, I didn't stop doing what I was doing. But, I have invested in Puerto Rico, not to the scale of the mainland, but, I participated in a number of deals with Robbie. I'm in on a deal on Calle Louisa, which is a hip restaurant, kind of restaurant row of areas. I've done a little bit of private lending. So, I'm slowly diving into Puerto Rico, but, unlike Robbie, who's got 20 years of like hands-on construction and you were going to the courthouse steps, you were always an operator. Yeah. I was an operator in my early 20s, but, from 2008 on, I was a banker. We were managing 30,000 loans, and at any given point, we would have 600 foreclosures all over the country. So I got very used to kind of analyzing data and being able to handle properties all over the country, looking at markets very quickly. And it was actually much harder on the mortgage side because you had to be the detective to find the information. Yeah. Yeah, on these larger multifamilies, we have all the information given to us, and if we ask questions, we can get more information given to us with highly professional brokers, and it's an institution, almost an institutionalized market. So, it's a market I like, and I love Puerto Rico as well. But what I'm not going to do is be the guy kind of climbing through a window on a vacant house to check it out before it goes to the courthouse steps. Those days are behind me, but I'll be a partner, a financier of Robbie, of you, and those of you that have that in you to do that hustle.
I'm always looking for a smaller person that I can throw through a window, because I've gotten to the point where I don't want to climb through the windows anymore either. And my wife refuses to let me push her through any more windows. So, you said something that I kind of resonated with. I like about Puerto Rico that the data is difficult, and so there is an arbitrage in that, and that's why we're here. And even one step further, with these small apartment buildings that we can buy here on the island, we don't need to know that this 10 unit is worth X, because I can figure out what X is a function of invested dollars to rents, right? Like, so as long as I can figure out what it'll rent for and I can buy it right, I don't have to have the data that says it's going to sell down the road. But then I'm not buying to sell either, right? I'm just buying to invest a few $100,000 and get a 20% return on it. And it's very easy to figure out what a 20% return looks like on a $200,000 or $300,000 investment. So that's why we came to Puerto Rico, is for those, buy them for $10,000 a unit, put $10,000 a unit in them, and rent them out for $500 or $600 a month, and call it a day, and keep that stuff for a long, long period of time until some smart people figure out how to showcase data and make everything easy for everybody, and then we will be sitting on a pile of equity, right?
Absolutely. That's just a great tip for anyone. It's basically the Burr model, but down here it's even, you've bought some stuff cheap enough you don't even need to refinance it. Yeah, but it's so simple. If you're not trying to gamble and flip, the math becomes very simple on, does the deal make sense? And when those numbers make sense over a period of time, the profits and the sale price is going to catch up. Yeah, they work. Even on a, not that a $45 million purchase makes sense, but even time will solve that problem. But on a cash flowing rental, it's only a matter of time.
Yeah. Yeah. And that's what we love about investing in value add stuff. You're on the island long enough, and anybody who's watching this that's on the island knows that if you drive around, there are just buildings after buildings that have been in a dilapidated state for a decade or longer. And if you can somehow figure out how to acquire those and then fix them up and put them back into the rental market, it's just a really wonderful way to protect your money, earn some cash flow along the way, do some good, provide some housing. I mean, there's a whole bunch of good reasons that buying that kind of asset makes a lot of sense. So yeah, I
Yeah,
always on my channel, come to Puerto Rico and check it out. You can't unsee it once you come here. It's an island paradise with just an amazing amount of opportunity.
absolutely. I did see a question pop up, then it disappeared. But oh, okay, yeah, there it is again.
Yeah, reducing the price in rentals and PR, at least in the metro area. So I think that we're actually seeing a fairly rapid rental increase, especially in the Condado area. It's gone crazy quickly, so that may slow down. But the kind of stuff that Jack and I are just talking about, working class type stuff, there has been a rise for sure. Like rentals have gone from when we first came to the island, it was like 500, 600, and 700. So a one bedroom was 500 a month, a two bedroom was 600, and a three bedroom was 700 a month. And now that maybe is 6, 7, and 8. But there hasn't been this crazy rise in those kind of rents either. So I don't think there's a call for a correction necessarily in rents. We have a housing shortage still, so there is reason to believe that rents are going to continue to rise unless and until somebody can put more houses on the ground, right? Like we just haven't built things on the island for a long time, and so it causes a housing shortage, especially now that we have a population growth for the first time in a long time. So.
Yeah, COVID did a lot of good for the island from a tourism perspective and or just the remote working perspective, unlocking, even some, some natives that were born in Puerto Rico and had moved to the States for a while that are now able to come back and work remotely.
Yeah.
In that Condado is La Verde type market, Airbnb certainly is driving up the price of long-term rentals for those of us that, we're trying to rent long term, and and those tend to be there's a few neighborhoods where those of us that have moved for some of the incentives tend to congregate as well. So a little bit of that is that, but it's those of us that have newly moved. But I think a lot more of it is the Airbnb and just the overall population growth that you mentioned.
Yeah, I certainly think that the tourist areas have seen a pretty big growth, and there may be a correction in that. We're in the Airbnb space, and what we saw in 2022 versus 2021 was something close to 15 to 20% reduction, right, year over year. So we didn't do nearly as well in 2022 as we did in 2021, and 2023 is starting off okay, but it doesn't look like it's going to be a gangbuster year either. 2021 was just kind of crazy because people were pent up, they couldn't travel, and they discovered that they could come to Puerto Rico without a passport. And it was like they knew they were going to be able to fly here and then fly home and not get stuck, where there were lots of places in the world that you couldn't say that about. So I think it's going to kind of settle out a little bit, and those rents where you live, Jack, may come down a little bit. I hope that that's the case, because I wouldn't mind buying some stuff in there, and right now it's just too expensive. I can't really afford to go buy anything in Condado. Imran asked another question. Don, can you put it back up for us? There may be a fund play in aggregating smaller multifamily and leveraging economies of scale. Yeah, that's what I kind of suggested to Jack, is that maybe we could go buy 10 unit buildings and have 100 units and get Jack to raise some money in his fund for us and partner that way.
Yeah, I mean, I think it's kind of a proven. It's like a private equity roll-up strategy, or if you look at the States, you've got Blackstone and Cerberus and large institutions who've done that with single family on the mainland over recent years, and there is interest. I've talked to a number of private lending funds and family offices. There's interest in Puerto Rico. Especially over the last few years, right before interest rates moved, where people were just looking for returns. Yeah. And funds and family offices are always looking to find some alpha, find some better returns. And the more this island matures, the more you keep doing things like this and getting the story out there, the more that these groups realize they can get down here and have a team ready to go that already has an established track record. I think good things will happen.
Yeah, I completely agree with that. I wholeheartedly back that statement up. That's great. So, at this point, we've been going a little over an hour. I think, Jack, that was amazing. And I love, if there are any more questions and you've got some time, we we can answer a few more questions, but if not, we'll probably wrap it up. So I like to give everyone who comes on my little Monday Night Live, Jack, one more opportunity to kind of give us a bit of knowledge. And you certainly have given us a lot tonight, but is there one more thing that you can kind of give us, a little pearl that you think this group could find value in?
Yeah, I think I mentioned it earlier. When I mentioned it's not always as simple as just being passive, but you just got to take action in whatever way fits your life and your profile. If you're a hands-on person, you want to deep dive into the business. There's more information than ever. YouTube, bigger pockets. Like you can get to any part of the industry you want to get to if you dive in and put some work into it. Those of you that are more passive or that have a full-time job, you're getting close to retirement, got to ask yourself a question. Do you really want to deep dive? Are you that type of person who wants to do that? Or are you the type of person that wants mailbox money? You got to figure out your investor avatar. And then once you figure that out, take the next steps to go there. So if you are more passive, go to Robbie, go to me, and really get comfortable with those that you're going to partner with longer term, and go to industry events. I'm going on a real estate cruise. It could be fun too. You can go on a cruise and network for a week. Most conferences are in fun places. I know there's a mastermind coming up that I believe you're speaking at right here in Puerto Rico. And then what is it, 1 week or 2 weeks?
Yeah, next week on the 23rd through the 26th, and it's put on by the Rio Rico. Last time they just hit it out of the park. There's so much value in coming there. I mean, it was one speaker after another, just had the whole room. It just completely captivated. And then we spend one day driving the island and looking at really, really cool and fun real estate projects. So anybody who does not know about that yet or would like to attend, we'll put a link below in the description here of this live.
Looks like there's another question.
Our market is suitable for a novice real estate investor to enter. Yeah, so why not? I think that we came here 5 years ago to buy single family and small multifamily houses, and here was the whole idea. We were going to get our money to go further than it would in the States, and it goes a lot further here, especially in the working class type neighborhoods where you can still buy something for $40,000 or $50,000 and fix it up and then sell it for something in the low to mid 100s. And you have a built-in buyer base of FHA buyers. And this is a very entry-level, easy kind of business to teach yourself with, I would call it extremely low risk. I think that there is a need for wholesalers. And if you watch my channel much, I think a little bit differently about wholesaling than most people. I think that if I was a wholesaler starting out, I would come to a place like Puerto Rico and be determined to buy whatever I was contracting. But if I could wholesale some things along the way, I would do that for the easy, low-hanging fruit, the cash. And that's something that novice real estate investors like to do. But anyways, I definitely think the more real estate investors that come to the island, the better it is for everybody at this point. There's more distressed properties here than the group of real estate investors that exist today could get through in a lifetime. So I absolutely think that this is a great market. This is the only market that we're really investing in. We still buy some stuff back home in Florida, but I put all of my blood, sweat, and tears in buying real estate in Puerto Rico because I think it's the place to be. So awesome. I think if you guys have any other questions, we could stay for another minute or two, but man, Jack, that was awesome. Thank you so much. I hope we can do this again. And you want to tell us how they can reach you, how we can maybe get out some information about your fund and stuff like that?
Sure, absolutely. Appreciate it. Again, thank you so much for having me on the show. I had a great time. We could do this for hours. We should definitely do this again.
Keep going.
So our website is JKAM Investments, short for JK Asset Management. So jkaminvestments.com. We actually we have a YouTube channel, not as active as yours, but we do post our podcasts after we do them go on our channel. We have a podcast called Alternative Investor Mastermind, and you can find that on iTunes, on Spotify. We have an ebook called Wealth Without Wall Street. If you go to the website and fill out a form, you can get a copy of that ebook. And I love to network. So any accredited investors out there, I love talking tax strategy. We have somewhat of an informal mastermind that we may formalize in the future, but love to just talk shop and see if there's opportunities to work together. So I encourage everyone to reach out.
Nice, that's great. And Jack and I met at a networking group. He's telling the truth. We've done deals together. I mean, we walked up to each other and kind of we're speaking the same language. And a month or two later, we're doing some real estate together. So I recommend you guys look at Jack's investment if that is something that is up your alley. I think he's doing great stuff. So thanks everybody for coming and tuning in. Again, Jack, thanks. That was awesome. Let's do this again. And hopefully you'll grab the footage from Adon and put it out on your sources as well. The more that we can kind of tell people about what's going on in Puerto Rico and for you, the better off. So just love it.
Absolutely. Robbie, I look forward to catching up again soon.
Yeah. Thanks a lot, guys. Have a good night.